Coming off the back of a weak GDP figure that fell into contraction territory for Q1 and a weak ADP number, where do we stand laying up for Friday's jobs report? Well, one thing appears to be certain. Volatility is on the cards and markets are pointing towards a possibility of further downside if we see a similarly weak jobs report coming on Friday. So what's the outlook for the likes of US stocks and the US dollar ahead of this key release? So first and foremost, as we always do, let's go into the breakdown for what the market expectations are. And as you can see here, there is an expectation that we see a sharp decline for the payrolls number. Of course, what we have been seeing over recent weeks is weakness for economic data coming out of the US, but in this form of soft data. That means that a lot of it is like consumer confidence or expectations figures, sentiment figures, those kind of things. Inflation expectation doesn't necessarily mean that that's where inflation's going, but it is the kind of things that people start to worry about if that's the first signal that you see as to the repercussions of Donald Trump's tariff wars. But we need to see it turning into hard data, and people will then start to gauge exactly what they think might be the outlook for what it might do to Donald Trump in terms of his decision making, also what it might do at the Federal Reserve and their decision making as well. So, like I said, a decline in terms of the payroll, certainly nowhere near the figure that we saw in terms of the ADP, but down to 140K. Unemployment expected flat, average hourly earnings 0.3, same as before, but the year on year ticking a little bit higher. Participation rate steady. So the notable part here is the expectations of a sharp decline in terms of payrolls, but it comes off the back of a relatively decent figure in March. Also, the U6, which is total unemployment, expected to move higher despite the headline figure expected to remain as is. And like I was saying, we haven't necessarily seen a major decline or deterioration in terms of the payrolls figures quite yet. You can see that we're sort of trundling around your sort of 130s up to your sort of high 200s, 300K kind of mark. And so the move that we saw last time was 228. So very healthy figure. Notably, we have been talking about the possibility that the sort of Doge cutbacks were going to have significant implications. But many people have been thinking that the Doge cutbacks have been nowhere near the size that had been initially laid out. But there's an expectation that we drop back down this time around. And so the breakdown in terms of what areas of the economy are particularly cutting back on job growth will be particularly important, of course, as Donald Trump points towards significant taxes on imports, which may be companies abroad selling to US consumers, but it also is many US businesses essentially based on the idea that they can get something produced abroad, they mark it up and sell it. And so if they can't get it in from abroad on the cheap, then that, of course, is going to massively hit their outlook for growth and therefore hiring. In terms of inflation, you can see here the downward trajectory that we have been seeing in terms of average hourly earnings, which is the light blue line on the top, have been mimicked by the core CPI figure. So inflation moving lower alongside wages. So wage growth as a proxy for inflation. What we have seen in terms of the core PCE figure just yesterday was that it came in relatively weak at 0%. We didn't see a huge move in terms of the year-on-year figure against expectations, but we did see a sharp decline in terms of the core PCE figure on the monthly figure. That was the same as the CPI and the core CPI, which also moved sharply lower. So inflation pressures essentially disappearing. In part, that will come down to energy prices falling, but of course, we also see these core metrics declining. And so part of it is also the fact that many people are not necessarily feeling as flush and not necessarily feeling like they're in a position to spend over and above. And businesses aren't in a position where they think that they're able to raise prices to the same degree quite yet. Now, whether we see those inflation pressures resurface with tariffs, that is the next question, and we're yet to see that. But at the moment, the sort of input prices, the wage price element of it has yet to pick up. And like we said, we're expecting to see it remain at 0.3 for the monthly basis. And so that 3-month annualized figure, you can see we're sort of around about in that same zone, that band that I've drawn on, which was the pre-pandemic level of wage growth. So notable that we don't necessarily need wage growth to be back to 2%, for example. That's not the target for wage growth. That's the target for inflation. And so as things stand, things relatively healthy on that front. Like I said, we saw the sharp decline in terms of the ADP figure on Wednesday. Now, over the years, we've all looked at the ADP figure and said, I wonder what this means for the headline number. And most of the time, it doesn't mean much, quite frankly. It doesn't necessarily give us that good a proxy for exactly what the figure is going to be in terms of the headline number on the Friday. But what you can say here is that a lot of the time it can give you a guidance on the sort of direction of travel. Like if you look at the last few months, it said that it was going to pick up last month. It did, and so the decline that we've seen this time around, is that a precursor to the decline that markets are expecting for the headline number? Likely to be the case. But whether it's a similar figure, that remains to be seen. You can see the differential between the two that I've got on the bottom section of this chart. You can see they swing as well. So it's not necessarily like you can see back in 2023, it seemed to always be the case that the headline figure was higher than the ADP figure. More recently, not necessarily the case. We have seen some more choppiness, but more often than not, it has been higher rather than lower. So the 120K would fall in line with that idea. In terms of wages, we've also this week seen the employment cost index, and that is a quarterly metric that you can see the purple line. And we saw it move down, but essentially it's sort of continuing the flatlining that's been in play over the course of the last year. And that signals a similar kind of thing for US wage growth. We have seen in terms of job openings a continuation of the weakness within that area. And now, when we look at the JOLTS numbers earlier in the week, a lot of the time you'll look at it and say, oh, sharp decline in terms of job openings. It means we're seeing really significant pressure on US businesses. We're not necessarily seeing them hiring in the same way. It can be a precursor to significant moves in terms of unemployment. But as we can see here, by and large, that downtrend for job openings has been going on for years now. And ultimately, it's just continuing that theme. We're not necessarily seeing anything untoward in terms of this chart at the moment. It's a continuation of that pullback and the normalization in many ways back to the sort of pre-pandemic levels in terms of job openings. But we're not necessarily seeing a rise in terms of unemployment to any significant degree. I think it's at 4.1 or 4.2 for US unemployment. It's inverted on this chart, hence it's looks like it's peaking out, but it's bottoming out potentially. Anyway, so by and large, unemployment would be an area to watch. We're not necessarily seeing a significant rise in terms of that quite yet. And then to wrap up this part of it, we're looking essentially at where the changes have been in terms of market expectations around the Federal Reserve for the course of this year. And you can see here that there is an expectation as the base case here that we move down to 325 to 350, which means 100 basis points worth of cuts over the course of 2025 from here onwards, essentially. Beside that, 125 is the second most likely probable or highest probability event. So you have seen a significant shift in terms of expectations that the Federal Reserve are going to be cutting interest rates on a regular basis. Now, this is notable because it means that people don't necessarily think the inflation pressure is going to take hold to the point where the Federal Reserve will have their hands tied. We have seen comments from a number of Fed members that have essentially said they're willing to overlook a short jump in terms of inflation if they know that it's going to be temporary in nature. But at the same time, you don't necessarily know it will be temporary in nature, because if you have one big boost in terms of inflation, suddenly that person that's paying more for all of their goods that are imported goes to their employer and says, well, inflation's now, 5%, 6%. I want a bigger pay rise. That then lifts prices, and therefore you go around in a circle, right? So, or lifts costs, and therefore it goes around in a circle and lifts prices down the line. So that appears to be the case. And markets, as things stand, appear to think that we're heading towards a potential recession over in the US. Of course, we've just seen that negative gauge for Q1, minus 0.3%. So will we see the same kind of thing in Q2? Well, there is a strong chance of that happening until we see trade deals brought across the line. But certainly this has implications in terms of a number of different things, such as the likes of the value of the US dollar, if you see increased rate cuts from the Federal Reserve. So let's start off with the US dollar, looking here at euro dollar. So euro dollar, the most popular currency pair, hence the one where I'll focus on it here. But essentially, you're seeing a pickup of late, a weakening in terms of the dollar, but this is the hourly time frame. So if we look at the wider time frame, we can see that this sharp rise seen of late has taken us back into this zone. I mean, look, we're talking about the potential for trendline resistance, but each of these has only 2 touches, so we didn't necessarily know. But there is a possibility that this wider downtrend does come back into play soon enough. But we have broken through that level. So let's see if this is a retracement of that move. Let's just grab a fib and draw that on. So as it stands, we're sort of coming up towards that 76.4 fib. The question mark here is, do we see a potential reversal coming into play for euro dollar, a strengthening of the US dollar after a period of really substantial declines? As it stands, you can see here that we have this sort of head and shoulders formation. So that there, and we have started to break lower with moves through some of these key levels, the likes of this in particular, 1131, and then below that, 1126. Ultimately, you still have a very clear uptrend over the near term. So if we were to pull back and start breaking through those levels, you'd be looking at the possibility of a sort of retracement into trendline support here. And so I wouldn't necessarily say, oh, look, we've seen a relatively large sort of upper wick on this monthly time frame and on the weekly time frame, and therefore it looks like this is going to reverse, right? I wouldn't necessarily be super confident of that, but certainly I would say that things are starting to change a little bit along the lines of the note that Donald Trump has reached out, or the US has reached out to China to try and find a trade deal, right? And these are the kind of things, right? People at the moment think that Donald Trump's policies are essentially undermining US exceptionalism. And that means that everyone's going to create partnerships around the world aside from the US, and the US is just going to see significant downside in terms of their growth outlook. And people are essentially talking about the possibility of investing elsewhere, moving money out of the US. Too much money is focused on the US. I don't necessarily think that that's going to happen personally. I think, of course, it's quite reactionary right now because Donald Trump is at the forefront of this and playing pretty hardball. But it appears to be the case that he's softening his approach, right? So the reciprocal tariffs got cancelled for all but China. Now here he is reaching out to China and trying to strike a deal. There's talk of him striking deals with India over the near term, the UK, those are some of the easier ones to get across the line. But he certainly wants to strike deals. And there could be a place down the line, let's say 6 months down the line, where everything is in a much better place. There's trade deals in place. The tariffs that are there are significantly lower. And so all of a sudden, people are saying, oh, why was I thinking that all of these other countries are going to be the outperformers over the long term, when the US has all of the biggest companies in the world, essentially. So, that move that we have been seeing recently, I'm not sure about, because if you see here, we've seen a breakage in terms of the relationship between, let's just get this on here, and I'll show you this. So let's say the dollar index against the US 10-year. So what we've seen historically has been a very close relationship. And then we saw this period here where all of a sudden we were seeing sharp gains. Of course, this is essentially Liberation Day, so-called. And we saw a divergence, right, where that close relationship then broke. We started seeing sharp upside in terms of yields, and sharp downside in terms of the US dollar. So we're now seeing that them converge, but we're seeing that inverse relationship still, right? So weakness in terms of yields, but strength coming back into play for the US dollar. So we're still seeing that inverse relationship that wasn't necessarily the case in the past. So let's see exactly how this plays out. But I think by and large, we're likely to see things return to normality before too long. And that could provide the basis for potentially US dollar strength if we're in a sort of troublesome position in terms of the near-term economic outlook, but we're not necessarily as fearful around the US rather than the world as a whole, as they start to strike trade deals, but data comes in relatively weak. Now, when we're talking about the sort of repercussions of this upcoming jobs report, we want to know whether weak data is going to give us a strong dollar or a weak dollar, because those relationships are all a bit jumbled up at the moment. So what's quite good about this is that we've already seen the ADP payrolls come in weak, and we've already seen the GDP coming in weak, right? And we've seen it around here on Wednesday. And so we've seen that leading into weakness for the euro dollar, weakness for euro and strength for the US dollar. So that points towards a possibility that we could see the same kind of thing, right? Downside for the likes of euro dollar if we come into a position that the jobs data comes in weaker than expected. And that could potentially feed into the idea that we start to roll over once again and come following this head and shoulders formation and come back down towards that ascending trend line. Doesn't necessarily mean that the wider trend of dollar weakness is over per se, but could extend that move that has been playing out at the moment. Now, of course, if you're looking at the implications in terms of the Federal Reserve, if we see a weak figure coming in, you would think that that would drive further easing from the Federal Reserve. So, that producing strength in terms of the US dollar isn't necessarily that much of a, doesn't necessarily make that much sense for a prolonged period of time, but that's something that we're seeing at the moment, which is more around the risk off demand for the US dollar coming into play. And as we've seen, the expectations around how much the Fed are going to be cutting this year, we're already pricing in 100 to 125 basis points. So relative movements, you may be overcooked it in that direction, quite frankly, especially with the fear that tariffs could spark a surge in terms of inflation. Then let's look at the Nasdaq. Now, the Nasdaq has been at the forefront of some of the selling pressure of late, but we've been seeing a strong rise over the course of this week. Now, what's notable here is that we've seen this move here, which was associated with that weak GDP and ADP figure, and then we saw a strong recovery. In part, this might come down to the earnings data that we have seen. We saw strong earnings data coming out yesterday from the likes of Meta and Alphabet. So where are we going to be going forward? Well, ultimately, we're in a position where if you're seeing widespread selling throughout the markets, you're likely to see the Nasdaq at the forefront of that. That being said, we've got Apple and Amazon reporting after the close today. And so that has another potential thing to feed into it ahead of that jobs report. But certainly we're in sort of recovery mode at the moment. Markets are clearly in a much healthier position. If you look at where we are compared to where we were previously, right? We bottomed out like mid 20s, so 26% lower. Now we're just 12%, 11% lower. I say just, but ultimately, it sort of feeds into the long-term narrative, which is we do see retracements. And that's a hell of a monthly candle that we've seen now close out as we enter May. That candle doesn't exactly scream a long protracted sell-off here. And so I'm personally bullish for this market, but aware of the fact that if we see weakness in terms of the jobs data on Friday, it could provide that same reaction that we saw in response to the ADP number. And in particular, if it's a particularly sharp decline. The caveat, of course, is that any weakness in terms of the near term can be overshadowed quite swiftly by an announcement of a trade deal or alike, right? So if suddenly the US come out and say that, we're having strong talks with China and, we're close to a deal, we want to remove all tariffs, we want to do this, we want to do that. Those are the kind of things that could quite swiftly eradicate the downside move, because people want to be long markets. People want to be long equities. And the US is the place to be, right? It's the most accessible. It's got the biggest companies in the world. It generally has very high growth companies. We've already seen from some of the tech names that they're growing in a very impressive manner. And people are now seeing this recovery and thinking, damn, I've missed out on a lot of it. So people are going to start chasing it. So near term, if we see weakness in terms of the jobs data, we could see more of this. But then bear in mind, we have the possibility of potential good news stories with the US potentially reaching out or apparently reaching out to China. At the same time, we're seeing strong numbers coming from big tech names. So keep an eye out for those Apple and Amazon numbers. Hopefully they can also outperform. But there's a big difference when you're looking at some of these companies like the sort of hyperscalers, some of the likes of sort of Meta and alike. And you compare that to, say, Amazon and Apple. There's big differences in terms of their reliance on physical goods. Amazon and Apple much more reliant on imports from abroad, and therefore tariffs are going to have a bigger implication for them compared to some of these big tech companies that own things like Instagram or Facebook. You know, they're not necessarily going to be impacted by restrictions on the flow of goods to the same degree. So certainly plenty to play for. But as it stands, you can see that short-term weakness around sort of weak economic data has been exactly that. It has been relatively fleeting. I have seen a number of people online talking about that the good news phase is over, and now it's time for the sort of bears to kick in once again. And the story around that will be ultimately that there hasn't necessarily been much behind this, right, in terms of volumes. And to some extent, this is sort of a lull before we actually get into the bad news. And the bad news could come in the form of the economy starting to go south. And this jobs report could be the beginning of that. So 120K, the expectations for the payrolls number, if we come in really short of that and we start to see unemployment surging, then it really puts pressure on Donald Trump to do something. He, at the moment, seemingly is quite chilled about it all. But certainly if the economy starts to roll over, then people start to readjust their expectations for earnings going forward. And we see some of these highly valued markets weakening once again. So let's just see, if we see weakness in terms of the job, just how weak that is. And if it's weak enough to really start to spark markets into a risk-off move where they think that suddenly we've got a recession ahead of us and China seemingly are more interested in mocking the US than having trade talks, well, that's when we could possibly see this rolling over in a more effective manner. And there you'll be looking at that ADP low of sort of 19,000 essentially as the level that needs to break to point towards a wider protracted move lower for the Nasdaq. I hope that's been useful. A particularly interesting end to the week ahead of us, and a busy week it has been anyway. You know, 10% lower in terms of oil, the Ukraine US deal, the moves that we've been seeing in terms of big tech names, the earnings, the numbers we've seen in the economic side of things with the ADP and the GDP. And, you know, there's so much going on at the moment. Great for traders. So I hope this has been useful. Have a great week. Have a great weekend. My name is Joshua Mahony, Chief Market Analyst at Scope Markets. Thanks a lot, guys.